Ticker symbol MO is up around 37% in the past year, and today we'll be looking at a company which has an extremely high dividend yield of close to 7%, which may potentially be a company under the radar, as it is only known for its dividend, but additionally its net margin has grown by 54% in the past year. So today we'll be looking at Altria, a tobacco company. In their annual report, they state that they responsibly lead the transition of adult smokers to a smoke-free future. They have some different product categories such as cigarettes, cigars, oral tobacco products, e-vapor products, and other tobacco products such as HTS. Now this company, what is interesting about it is that it was actually the parent company of Philip Morris, but they broke apart in 2008, and since then, both of them are the biggest tobacco companies in the world. As I stated in the Philip Morris videos, these tobacco companies, it looks like they're actually apologizing for what they do in their annual reports. They say that they're in favor of the government actually imposing rules to stop the youth from starting to smoke. They say that their main objective is to develop products to replace cigarettes. But even though they say that a lot, their main product and their main source of revenue comes from cigarettes, and they make billions of dollars from that. Now the thing about these businesses is that they're extremely predictable because people are addicted to tobacco. So you normally have a similar amount of revenue every single quarter. Altria is the family of companies that currently include Philip Morris USA, US Smokeless Tobacco Company, John Middleton, Helix Innovations, and Enjoy. Some of these companies are now offering alternatives to cigarettes, such as the one you can see on the screen over here, which are similar to the IQOS brand that Philip Morris is offering. They are just here to replace cigarettes, and at the same time, they're actually more profitable to the parent company itself. Additionally, in their annual report, they state that by 2028, they have committed to grow the total US smoke-free volumes by at least 35% from the current base of 800 million units. But I think they will reach this a lot sooner. Having said that, I'm not the biggest fan of smoking and of cigarettes, but when we look at their financial analysis, this company is a complete monster. Has a 55% return on capital employed, which, just for you to put this into context, our usual threshold to consider that a company is of high quality is a 15% return on capital employed. Now they have a very solid interest coverage ratio of 10 times, basically meaning that they won't have to worry about debt anytime soon. Then they have a cash conversion of 98%, a profit margin of close to 60%, and an operating margin of close to 50%, whereas the threshold we also use here is 15%. Now, the one thing that this company is known for is, of course, decreasing revenues. On the other hand, we can see that the net margin has been increasing at an exponential rate since 2022. And why is this? Well, since Altria's revenues are decreasing because of volume decreases, meaning that they sell less number of cigarettes, they have to try and make money in a different way. And how can they do this? Well, this is done by increasing the average price of cigarettes. And this inherently increases the net margin as they're now charging more for a product that costs the same to make. But overall, even if your revenue decreases, what investors get at the end is free cash flow, which is derived from net income. So this is very positive and it depicts a very high growth. The only problem with net income is that its growth is limited. Now, when we look at their efficiency ratios, of course, these have been very stable, but they have been increasing due to the net income increasing. One thing over here is that the return on equity actually stopped being accounted for in 2022 because equity went negative. So you can't have a return on equity when equity is negative. And we can see just that over here. We can see that since 2021, their total liabilities have been above their total assets every single year. And this is a similar problem that Philip Morris actually had. To me, whenever a company has negative equity, it immediately raises a red flag which must be studied in deeper detail. Now, when we looked at the Philip Morris example, they had had a negative equity since 2014 and they were doing just fine. So this company gets a solid 5 out of 8 ticks, as they first of all have a very low liability risk with a 10 times interest coverage ratio. Their cash flows are incredibly consistent. Now, additionally, they pay a very hefty dividend, which is great for investors. And additionally, they buy back shares whenever they have free cash flow left. And of course, this company meets the two most important criteria from this slide, which are pricing power and having an existing moat or competitive advantage. Now, regarding pricing power, this is very easy to define with Altria and with other tobacco companies because it is exactly what they have been leveraging for the past 50 years or more. And the thing is, tobacco is a product that actually has a very high percentage of the population which is addicted to it, meaning that they can't stop purchasing this product. This basically causes demand to be very inelastic, meaning that demand is not responsive at all to price increases. Even if Altria decides to increase prices, this will not make customers go away from the product. So sadly, this is the reason why this company has a lot of pricing power. But this can have a counter argument, which is that every year, taxes on these type of products are increased and they're more heavily regulated. This means that customers are getting double price hikes, one from the company and one from taxes, which to be honest limits the potential of the price hikes for Altria and for other tobacco companies. But they're still making a lot of money in this way. And now the second one is their existing moat or competitive advantage. Of course, Altria is not the biggest in the world, that's Philip Morris, but they still have a business model which is very hard to imitate, and they have reached a scale which is almost impossible to replicate. They have of course created very high barriers to entry for their industries, and now especially that they're moving into cigarette replacement products, they're even creating barriers over here. In the past, you could go to a machine and buy whichever cigarette and you could smoke it without any problem. Now, you can only smoke those cigarettes for which you have the machine for. So if you have an IQOS machine, you can only purchase cigarettes from Philip Morris. If you have an Enjoy, you can only buy Enjoy capsules. And the three things that I didn't like from this fundamental analysis are, first of all, this company does not have a solid balance sheet. Since they have negative equity, I cannot award the point to them. Then they're not able to grow their free cash flow organically, and they're not able to grow their revenue organically. As we have seen, their revenue is actually decreasing. But now they pay a very hefty dividend. They usually pay a dividend yield around 7 to 8% with a payout ratio of 68%. This means that a very high portion of their net income or their free cash flow is actually awarded to dividends, which may limit dividend growth in the future. And now when we look at valuation ratios, this company is trading at a low valuation in comparison to the past 4 years. Additionally, when we look at their free cash flow yield of close to 10%, if we compare this to the 3% long-term inflation rate, this may actually consider the company as being traded at undervalued prices. Now, when we look at risk and possible challenges, the main one that I see is of course regulatory risk, and this is due to the fact that there are a lot of countries nowadays which are trying to break down on smoking, and the way they're doing this is by banning the sale of cigarettes or other smoking products to young adults. They have worked out that they cannot just ban the product for everyone because those people who are addicted still need to buy these products to satisfy their addiction. However, what they can do is ban it to this so that the younger generations never get started and they avoid and clean up this long-term problem. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. Now, I believe that this company has a strong competitive advantage. It has consistent cash flows and it has one of the highest return on capital employed I have seen, so I believe that this is a good company and it may be a good investment, but it has high regulatory risk and it is in an industry which I would not like to take part of. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content and I'll see you in the next one.